Hi, everybody. This is Dan Sheridan, Sheridan Risk Management. And today I'm going to talk about long diagonals a little bit, poor man's covered right. And here's a price chart of Microsoft. I'm going to use that as an example. And you can see generally this isn't the same horsepower as like an NVIDIA or Tesla or Planter or any of those that really move crazily, excuse the expression. And you can see here's over the last 3 months, relatively tame. It can move, but it's not going to, if we look at a chart of NVIDIA, a little choppier with the candles or price movement, or Tesla, boom, it could really move um, quite a bit. Microsoft is a stock. I'm not going to say it chugs up, but it goes up not too fast. And I think this would be a good candidate for uh, people might look at that and do a covered right. You say, Dan, what's a covered right or a buy right? And it's simply buying the stock. That's a graph of the stock. You have 100 shares of stock in Microsoft. The current underlying is around $516. And every dollar it goes up, you make $100. And every dollar it goes down, you lose 100. And it gives it a delta of 100 because if you own 100 shares, it doesn't change unless you sell it out, whether it goes up $30 or $2, you have 100 shares of stock. Whether it goes down $2 or $30, you have 100 shares of stock. On the upside, you're making $100 every point. On the downside, you're losing $100 every point. And you can see it has a 100 delta. Delta just means what I look at it as if you do a delta like an at the money 50 call, as it goes up, your delta will slowly work its way to 100. On the way down, a long call, the 50 delta will slowly work its way to zero. So stock, it stays at 100 delta. But let's say, okay, we like Microsoft long term and say, hey, it doesn't move up fast enough. Every month I'm going to go sell a out of the money call, maybe a 23 delta or 20 delta or something that has, one of the definitions of delta is that you can see, well, I guess this is 26 delta. So one of the definitions of delta is there's only a 26% probability we'll go through the short strike by expiration. So there's a good chance in a stock like Microsoft, you can make money from price appreciation. And in this particular trade is October 24th. So maybe let's see, October 24th is 24 days. So the ideal play would be it goes up, stock goes up, you make money on appreciation, and the stock in this period of time, Oct 24 is 24 days, doesn't go through the 535 strike. And that's why we're selling a relatively low delta of 26. And that's the trade, right? If it goes down, you sold the short call for $4. So the first $4 down, the premium would cover uh, the adverse effects. If you're long stock and we go down, you'd lose $100 for each point. So to help you for about $4, and then dollar for dollar, you're going to lose $100 every point because you're still long the stock. That short call or protection to the downside will only help you to the extent of the premium of the short option. Now, if we look at the margin on this trade, and I'll just say CW covered right, you have to buy 100 shares of Microsoft, which is going to be around $51,000 because the stock is $516.69. And you could reduce it by the amount of your short call, which is $4. So let's even call it, $515,000. Excuse me, 51,000. Let's just call it $51,000 to do one covered right. Right? That's how much capital that you would put up to buy 100 shares of stock and sell one out of the money call at 535. And so when you look at your yield, you're taking, even if you make, $400, what could you be expect to make? I'll just round it. $400 divided by, let's say you put up about 51,000 for the stock. You're talking 0.007. Now, you could talk in instances, so that's what you'd expect to make on the $400 calls. In the best case scenario, if the stock went up to our short strike, 535, but didn't go beyond it, the best you could do with this would be, if we went to 535, it says you can make about $2,200. You see the number in blue is at expiration. So if I'm up here around $2,200, well, how does it come up with $2,200? I'll just put best. How could you make $2,200 in the best case scenario where Microsoft goes from the current, roughly 515-ish, it's near 516, but 515 to 535, you'd make $100 for each dollar. And if it goes up $20, you'd make $2,000 on the stock plus $400 on the short call. If we don't go through 35, you'll collect the entire 400. So best case scenario, and this would be a 535 or higher, you'd make your, $2,200, right? At 535 or higher. Now, you compare that with, we're going to call it you've got the numbers, and that would be higher, right? If you made $2,400, best case scenario, if it goes up, because it is a long delta position, a covered right. You're starting out about 73 deltas long. Dan, how did you get that? You're along 100 shares of the stock, and you sold a 26 delta against it. 100 from 26 is going to get you around that 74 deltas. So if we go to 535, best situation, you're going to make $2,400 divided by, let's say, 51,000. And that would be, but that's like a home run for a covered right. That's like 4.5%, right? But normally covered writers, if you can get 1%, you'd be thrilled. Now, let's contrast that with a poor man's covered right. This is called a long diagonal. It's called a poor man's covered right. You might have another name for it. And all we did here is I went in there, and instead of buying the expensive stock, I went in there and bought a DC-19, in this example, 470 call. All right, so I bought a DC-19 470 call. You could go farther out, you can go closer. I just chose 80 days here, and I'm buying the 470 call. It's an 80 delta. So unlike stock, you put up 51 grand, but you're only making $100, right, for every dollar up. So if it goes up $1, you're making 100 divided by 51,000. If you buy an 80 delta, and eventually that 80 delta, as Microsoft goes up, is going to continue to go higher towards 100. But when you start it, you're paying, it's an 80 delta, so I'd call this a stock surrogate, and you're paying around $5,600, $5,700. Let's call it $5,700 for the in-the-money 470 calls with 80 days to go and 80 delta. So every dollar up, you're making $80 divided by 5,700. So would you rather make $80 divided by 5,700, which gives you a return of 0.014, right? Would you rather do that? Or would you rather buy 100 shares and put up 51,000, which is, what did we say, 0.007 or something interest rate. So that's the whole idea of buying it, around an 80 delta. You can buy a higher delta, lower delta, but this is just one way of doing it. And then I'm selling the same call, the OCT 24 535 call. And so if you just took that ideal scenario where it went up to 535, that's the best a covered right could do, maybe make 4.5%. And a diagonal, instead of putting up 51,000, you're only putting up $5,200. Right? Remember, we said that we're putting up the cost of the long call, the 470 call. We're paying about $57 for the long call. And the short call, we're bringing in $4. So the difference, we're paying about $5,300 for the trade. That's our capital, right? So if we go up, folks, on a best case scenario, if we go up to around 535, you can see this diagonal will be up around 1,700, almost as much as the covered right? But the best thing is, covered right, you're maybe up $2,400, but you're putting up $52,000. Here, you'd make $1,700 potentially, but you're only putting up $5,200, 10 times less money than the covered right. So your returns conceivably could be over 30% in the best case scenario. But so it's a very interesting strategy, the diagonal. In this case, we started out about 54 deltas long. Your long call was 80 deltas on the diagonal. Your short call was maybe 26, which gets you around 54 deltas long. And you can think of terms of delta as stock equivalent. We go up $1, you make $54, goes down $1, you lose $54. Um, but anyways, I wanted to just kind of throw that at you to get you, if you've never kind of looked at that like that. And if you're interested more on that topic of diagonals, starting tomorrow, September 1st, we'll be on our in our community on Mondays and Wednesdays at 2 Eastern. It'll be recorded. We'll be doing a deep dive into diagonals and the different ways to use them. And I think that'll be a helpful thing. And all you need with that, if you're interested, you could check us out, SheridanRiskManagement.com. For one price monthly, you get everything. The live couple hours of live content a day, all our recorded video, the recorded videos that we have. You also get the any on-demand classes, trading groups, Discord channel where we put live trades. So if you're interested, check us out, and hope that helps you. Thank you.